Greetings, members, one and all of the Salivation Nation, visualizing the price of gold from 1915 to 2020. Let's explore. Some of you may remember I posted a series of videos on gold and silver. About 100 years of history of the price proves their worth. And this is a unique opportunity to see sort of the same type of data played out, visualized in a visualcapitalist.com infographic called Golden Bulls, how gold performs. It says here that gold has always been a store of value, but there are periods when the growth is explosive. Since the U.S. gold standard was abandoned in 1971, gold has had two major bull runs. We are currently in the middle of the third. The question is how long will it last? You know, in some cases we can use history to kind of judge that, to kind of give an indicator, but we are in unprecedented times. We've heard that from time and time again. And here we can see these inflation-adjusted returns and the nominal returns. Here we can see how, gold, inflation-adjusted, would be about $2,066 today. But it did get up to nominally $1,925. But I've heard some numbers go over $1,900. That might be an average of some sorts. But here in May of 2020, it is up to $1,726. It's actually pulled back a little bit since the recording of that. But very, very interesting indeed to see. Here we can see this graph, and we can see where the inflation-adjusted numbers are. So in the timeline, we see 1933 or in 1929, the stock market crash marked the beginning of the end for gold as money. In the wake of the financial collapse, investors started redeeming paper currency for its value in gold, removing currency from the economy. Then in 1933, gold coins withdrawn from circulation. Gold standard was partially abandoned. And as you remember, that was the time when the FDR had his famous executive order where people were ordered to turn in their gold to be paid I think $20.67 an ounce. 1934, Congress passed the Gold Reserve Act. And by the way, 1913 was the Federal Reserve Act. And then here in the early 60s, the price of gold was set by the U.S. government and kept financial markets and the price of gold stable during the era of unprecedented growth. And then in 1971, it was complete. The gold standard was abandoned. And look what gold did after that. It took off. Crazy. And in 1980, it went up to insane numbers. And inflation adjusted, it almost got up to where we are today. But nominally, it went much lower. I think it was $800 and some an ounce, if I'm not mistaken. And then we see what happened here. From 1969 to 1980, the end of the gold standard. And then from 1999 to 2011, we have started to see radical monetary policies. And boy, they've just been set into overdrive as of late. And now, from 2015 to now, gold is in the new financial landscape. And has anybody's guessed what that landscape will be? So we have a description of some of these eras here. The two powerful, long-lasting bull markets in the modern era of gold, which lasted over 10 years. And then again, we see here that the orange, yellow is inflation-adjusted returns, and then the black is the nominal returns here. We can see the end of the gold standard from December 69 to January 1980, although 71 was really the where it ended here, but it says we can see where the numbers were. $42 an ounce in December 69. Takes office, Fed raises rates. In 1971, Nixon tells the Fed to not honor the dollar's value in gold, which, by the way, the meeting that led to that, those who attended the meeting were of the understanding it was only temporary. It turned out it wasn't temporary, for sure. And 1974, Ford allows private ownership of gold. And we see a lot of metals were created by the U.S. Mint during that time, but no coins. And so January 1980, $678. I thought I've heard of that went up higher than that, but of course, inflation adjusted January 1980. Inflation adjusted says $2,234, up 684%, which is a little bit different than what this chart shows, because inflation adjusted here is $2,066. This should be a lot higher. Why that's not showing correctly there, I don't know, but that's a mistake in their graph. Number 2, the radical monetary policies from August 99 to August 2011. We can see here $257, August 1999. I remember when it was that low. And we can see inflation adjusted. It's not much higher, $394, well undervalued at that point. And I even thought at that time, man, should I be buying more gold? And I thought, man, it's low. I don't want that. I don't want it if it's low. It might stay low. It might go lower. That's the psychology of the thinking at the time. Hindsight is always 20/20, right? 2008, the global financial crisis, and then the Eurozone crisis, and the flash crash of 2010. U.S. sovereign debt downgraded, and we can see what happened, where in August 2011, gold went up. They say 1825, but I swear I've seen 1900 other charts. Again, that must be average out there, but there you go. The current bull market is nearly 5 years old, and the new financial landscape may give it room to run. Now, I'm not sure really why they're separating it from radical monetary policies, because we are still in radical monetary policies. To me, I would keep it in with lump it in with number 2. And we can see here the price action during that particular time of 55 months. In November 2015, gold was down to $1,062, and adjusted for inflation, just over $1,100. Then in 2018, the Fed hiked. U.S.-China trade war begins. And yes, we're underway there. COVID-19, 2020, and it goes up. Crazy. And look at that. Here we are, May 2020, and shockingly, the real price, the nominal price, and inflation-adjusted price are the same. I don't get it. No, that's because we are in the here and now, and that's where inflation is. A little joke there. Gold and the rest. Some people consider gold to be a shiny paperweight. However, in comparison to other asset classes, gold is far from a pet rock. And so let's take a look here. This shows for 1 year what gold has been doing compared to other commodities. S&P 500, it's pretty flat. Non-U.S. equities is down. Emerging markets is down. The U.S. dollar is only slightly up. U.S. bonds are doing well, but not as well as gold. Other commodities are down. Gold is up over 30%. So that's pretty exciting to see. However, if you look at it from a 10-year standpoint, doesn't lie. The S&P has done better over the last 10 years. And in fact, so have U.S. bonds. But commodities, not so much. The U.S. dollar has not. And emerging markets have not. So there you go. And over a 20-year period, though, however, it looks like it's the other way around. Gold has performed better over the past 20 years, for sure, than any other market out there, with only emerging markets and S&P 500 in a distant second place there. So that's pretty interesting to see the returns there compared to these other assets. And it says here, this is, by the way, this infographic is from Sprott, Physical Gold Trust, and they're obviously, a precious metal firm. It says gold will continue to be a sought-after store of value, offering protection against financial crisis and the devaluation of fiat currency. So there you have it. But it's interesting and really cool to see more infographics starting to be produced now. I think what happened is a lot of these infographics, they kind of shelved off. You didn't see them quite as much because people weren't as excited when after 2011 the markets went down. People were kind of jaded, disappointed. In fact, we see a lot of that for silver even to this day. But when they go up again, people start to gain excitement. They take the time to make these infographics, which really do hold true. And so there you have it. The case for gold, inflation adjusted. It does very, very well. I look at gold as the ultimate hedge against economic instability. I hope you do as well. And I'm going to continue to accumulate it. When the prices go up, I'll just buy less of it. If they go down, I'll try to buy more of it. But I believe it's the ultimate hedge. Economic instability provides lower risk than other asset classes out there, including silver. But silver, I believe, still was a hedge against economic instability as well. It just takes a while, and you gotta keep in mind dollar. It's probably easier to dollar cost average with silver because you can buy it in so many different increments and sizes. And when I'm talking about sizes in terms of dollar amounts, you can buy 50 ounces one particular time, or you can buy 10 ounces another time. If it's really expensive, you can buy 10 ounces. And if it gets really cheap, if you have the financial means to do so, you can buy 100 ounces. And you can dollar cost average in that way. Gold is a lot harder to do that. It's fractional gold. Typically, you have more premiums in the time where the markets are tight and premiums are high. It becomes especially difficult, really, for both metals. But interesting indeed. Gold is money, and I think this is a further argument for that case. So there you have it. So post your thoughts below. We'd like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.